Macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Where is this bull market headed? I'm going to try and tell you right now. First, let's take a look at my scenarios and probabilities map that I gave market timers in late February. So this is something I do about every month, and these scenarios and probability maps are good for about 3 to 4 weeks. It times well when we're headed into an FOMC meeting, which we are next week. So you can see that actually I was a little too cautious after that big 6% correction we had in January, and the market found its footing again and was headed back towards 1850. I thought, hey, we could still test back half of that, and so that was sort of my base case high probability scenario where the S&P would retrace 50% of that Feb power rally back to 1780 support. No such chance. Couldn't even get near 1820 again on the S&P. And we've since made those new highs above 1880. Right now, today, we're headed back. We've been headed back down a little bit. The market sort of reached a peak, and the Russell sold off hard on Tuesday, down 1%. And we'll take a look at the Russell in a minute. And look at all the fear that's going on here. First, we have the Ukraine situation. There's a vote this Sunday. Then we have two big drivers of bad news out of China. First, their trade balance totally did a switch, and they, less exports, and maybe they're reporting those facts differently. And then the other big news for China is, what's going on in the shadow banking system. Is credit drying up, and are there going to be some institutional failures in China, and what is the central bank going to do about it? Is any of that fear taking the S&P racing down through 1850? No, it's not. All right, let's go to a couple charts now. First, let's just take a look at the S&P and where I see support. Obviously, this top here at 1850 will be a magnet of support on the S&P. And I've got moving averages on here, 20, 50, and 100 day. They all kind of define the trend. So yeah, this market could make a trip down to 1820, but I would be a big buyer there. And we're already well long in market timer, looking to add things like the Russell 2000 and the NASDAQ on dips towards 1850 or below. All right, next let's compare the Russell 2000 and the spiders. This is a ratio chart, IWN versus the SPY. It's a 2-year chart, and you can see when this ratio has gotten to 64%, IWM versus the SPY. It's 0.64 on my chart here, but just call that 64%. When it gets up there, that's a little toppy. Actually, it's been higher, though. In 2011, this ratio got to 65%. So this is not uncharted territory for growth being ahead of big caps. And I don't see the Russell getting a ton weaker here. Everybody's thinking it's the most overvalued index, but actually it's helping lead the bull market higher because fund managers are betting on the small caps for leverage in a strengthening economy, in a strengthening cycle. So this ratio could easily pull back to 62%, and you'd want to be a buyer there on a relative value trade of the Russell versus the spiders. All right, next, I want to talk generally about my beliefs about this bull market in a strengthening cycle. And as much as I thought we really needed a 10% correction at some point, and I still do, this thing's going to go on. And so let's look at some core beliefs here of this strengthening cycle. I think the secular bear market is over. I told you that at the beginning of the year. And barring a recession, which I don't see, anything that happens, S&P 1600 will be strong support. I see the S&P going to 2,000 this year, and probably to, believe it or not, S&P 2,500 in the next 2 years. I know that seems like a stretch, but this market looks a lot like the market of the 90s. And after a strong year, we're probably going to have another strong year after that and another one after that. And so S&P 2,300 is definitely in the cards, I think. And you don't know how much stronger the economy can get, and we're going to talk about that in a minute, that could propel earnings to 130 on the S&P and take us to 2,500. All right, a couple other things. Yeah, we need a 10% correction. We need a washout of weak hands. I don't think that's coming until after April. Who knows? We could have a repeat of last year where we skipped the whole sell in May thing, and it's just sideways from May. Lastly, let's talk about emerging markets. I've been quoting this stat a lot lately. This comes from Artisan Partners based on some OEC data. OEC did a study in 2010 where they said that middle class spending was at 21 trillion, and that was less than 2 billion people. But that the size of the global middle class was going to double by 2020 and take middle class spending to 35 trillion. All right? So by 2020, we could be looking at 35 trillion in middle class spending with a middle class possibly as big as 2.8 or 3 billion people. And that's something I've been talking about since 2010, that we have 2 billion people clamoring for the lifestyles of the West, and governments in support of that, creating development. The next stat here is that middle class spending could grow to 56 trillion by 2030. So, these are big numbers, long-term projections, but it's the mega trend, really, of emerging markets. All right. So now let's talk about internally in the U.S., what could drive growth and drive a growth pickup, a jobs pickup, and keep earnings momentum going? I think it would be CapEx spending. I've been talking about this for a year, been waiting for it. In the past 3 weeks, we've gotten research from major houses like Citibank, UBS, and then I just found this on Josh Brown's blog yesterday from BofA Merrill. And here are 10 reasons for a CapEx pickup, according to the Equity and Quant Strategy Group at BofA Merrill. All these things in our favor. And the last one's kind of important. Investors have said, hey, we thank you for the buybacks, corporate America, but now why don't you use that cash to invest and really keep this cycle going? Invest in the future, and obviously that creates jobs, and it sort of creates a momentum. And I think, if politically, if the administration does something right and gets corporations to bring cash back, which I just saw figures this morning, it grew 11%, well over 200 billion overseas. If we can do something to incentivize that cash coming home and investing in, plant and product in the future, that creates jobs. This trickle could get going, so to speak. It really just needs a spark, because if you're a Fortune 1000 corporation and your competition is plowing money into CapEx to increase their market share, I think it sort of motivates you to take the same stance. So that's sort of the macro picture that underlies my bullishness. CapEx and emerging markets are big drivers, and I think you still want to be buyers of the dips in this market. At least into the summer here, and maybe we take a break in the summer and it's another sideways affair. Just saw a fresh article from a strategist this morning. Guy used to run strategy and portfolios at Value Line. Now he just manages private wealth. He's calling for S&P 2100 by September. Now that's uber bullish, I think, that this market could avoid a sell in May event, when I think, most Wall Streeters would like to take some profits and go on vacation. That's a super bullish call, and I'll revisit that next week, and we'll talk about some more charts. Meanwhile, you want to look for places to buy this, and I think that the Russell 2000 and the NASDAQ are telling you that breadth is alive, and you want to be positioned for growth. Hey, inflation could be around the corner for all we know, even though it seems like the specter of deflation is still with us. The key thing is, though, the reason that the Fed is telling you, hey, we're going to keep interest rates low out of 2015, is because they want this recovery to get legs. They don't want to end up like Japan, and they don't want to end up like Europe. All right, so that's my macro strategy take, and my argument for buying the dips here for a very strong bull market for the next 2 years. All right, I'm Kevin Cook. Thanks for joining me in the kitchen.